Hi there, and welcome to this on-demand financial education workshop, how to get a 750 credit score and keep it. A little bit of introduction since you can't see me. My name is John Maroney. I work at Canopy Credit Union. I'm one of our certified financial coaches and our financial education officer. A little bit about my background. I was a financial blogger from 2014 to 2017. I've also continued to work as a freelance financial writer, and my personal financial goal is to retire by the time I turn 40. I'm 33 at the time of this recording, so I have a pretty aggressive financial goal. So I love talking with people about their money, whether it's budgeting, saving, their credit scores, which is what we're going to talk about today. This is really my passion, so I'm excited to get to share this with you. So when I say the word credit, what comes to mind for you? Do you think of credit cards? Do you think of loans? Do you think of your credit score, your credit report? There are lots of different things that come to people's mind when we say this word credit. We're going to talk a little bit about some of those key things today. So first of all, let's start with, why does good credit matter? Why should we care about our credit score and our credit report? Well, first and foremost, it improves our access and it lowers our cost for a lot of different elements of life. The first would be our borrowing needs. If you ever need to borrow money, whether for a mortgage, an auto loan, a personal loan, or a credit card, you're going to pay less when you borrow money, the better that your credit score and your credit report are. It can also impact your accessibility for housing, whether renting or buying. If you're buying and need to get a mortgage, obviously the better your credit score, the more affordable that mortgage is going to be. But if you're renting, one of the things people don't often think about is how a landlord will look at your credit score and your credit report as they are screening potential tenants. And currently in Spokane, we're dealing with a very hot rental market, lots of tenants. So the better your score and the better your credit report, the more attractive you will be as a potential renter. Transportation. So one of the things that people don't realize is that or many people don't realize, is that your credit score can actually impact what you pay for your auto insurance premiums. In fact, depending upon your carrier and how they grade you out, you sometimes may pay more for having a poor credit score than you will for having an at-fault auto accident on your driving record. And the reason for this is insurance companies, they look at big data, and what they've found is that the lower your credit score is, the more likely you may be to file a claim. And customers that file claims are unfortunately more expensive for them. And then communication services, especially if you are looking to buy a cell phone and a credit check is part of that payment plan. Again, the lower that your credit score is, or the more challenging items that are on your credit report, you might end up paying more for those services. So good credit is very important. It impacts so many different elements of our life, not just when we need to borrow money. And to illustrate this, I've broken down what someone would pay based on their credit score for a $150,000 15-year mortgage. Now, these interest rates are from our credit union specifically, and you can see here. So someone who has a 750 credit score, that's going to be A+, it's excellent, is going to be at an interest rate of 3.5%. Their monthly payment, if they borrow that $150,000 at that interest rate, would be $1,130, and they will pay back in total, including that original $150,000, $203,084. So they're going to pay about $53,000 in interest. And you can see as we go down this scale, so someone with a 680 credit score, their interest rate goes up by about 0.25%. Their payment only goes up by $20 a month, and they only pay about $3,500 more in interest. But as we continue to go down the scale, if I go down to the person with a 630 credit score, their interest rate is 3% higher than someone with a 750 credit score, 6.50%. Their monthly payment is $1,368, and they're going to pay back about $43,000 more in interest because of that 120-point difference in their credit scores. So again, when we talk about how vital and important this is, I want to illustrate that this really translates into dollars and cents for each one of us. It's very important that we know what's going on with our credit scores. And to further illustrate this, we look here. This would be interest rates, payments, and total interest repaid if someone were to access a $15,000 60-month or 5-year auto loan with us. So you can see the interest rates here. What I will really just highlight for you is, again, doing the top. If your score is at a 750, that interest rate is going to be 2.99%, very affordable. Monthly payment would be $270, and the total interest that you will repay in addition to that $15,000 you borrowed is about $1,168. So again, very reasonable. If we go all the way down to someone who has a 540 credit score, so 210 points in difference, the interest rate is at 14.74% APR. So you can see it's a lot higher. The monthly payment, $355, so $125 extra per month. And look at especially at the total interest that has to be repaid on that loan, $6,288.30. A pretty significant difference for those differences in credit score. So when we talk about this, again, it impacts our bottom line. What I like to tell people is that the better your credit score, the more affordable all of life can be. So we want to equip you with the tools and resources to understand how your credit score works, how to improve it, what steps you need to take to hopefully make all those aspects of life more affordable for you. So let's jump into that. So first of all, let's talk about the reporting agencies. So you have your credit information is with Experian, Equifax, and TransUnion. And each of them reports and calculates your score a little bit differently. And you may not have known this, but you actually have dozens and dozens of credit scores because there are a lot of different models that are out there. Now, the most common one that we know about is the FICO score. That FICO stands for Fair Isaac Corporation, and they're the company that came up with the algorithm to determine credit scores from the information that these agencies have. So, but a question you can always ask a lender or somebody who is pulling your credit score and your credit report is, hey, tell me what model you guys are using. There are different models that are out there that can have different impacts upon what they see when they pull your credit. Now, let's really quickly talk about your credit report and your credit score. Those are actually two different things. So your credit report is the summary of your financial reliability and your history utilizing credit. You can kind of think of it as if you were getting a report card. This is the narrative side of the story. And then the credit score, that's the numerical value calculated based on the information in your credit report. So this would be like the score that you would get on your report card. So for instance, an A, a B, a C, et cetera, et cetera. But keep in mind that those are two different things. And there are a couple key reasons why that's important to know, which I'll point out just a little bit later. So what is included on your credit report? So again, if you've never looked at your full credit report, this is information that you'll see on there. So there's a lot of personal information, names, including, so if you've gone through a name change or anything like that, previous addresses. So it's always good to be monitoring your credit report to see what addresses are reported on there. Your employment history can sometimes be on there, current and previous employers, phone numbers, and obviously personal identifying information. Your social security's number is on there. And then all the credit items. Are there any collections, late payments, bankruptcies? You'll have information about all your open and your closed accounts, credit inquiries. There's a lot of detail that is on your credit report. And so getting into the practice of accessing it on at least a yearly basis and checking through to see if there are any errors or issues is a really good practice. In fact, about 20% of American adults have some sort of error on their credit report. Now, it isn't always going to be something serious that's impacting your score, but that's why it's vital and important for us to be checking that information on a pretty regular basis. And we'll talk about how you can do that just a little bit later. So some information that's not included on your credit report. And I think this is important for people to understand, again, what's on there, what isn't on there. Any criminal background, not going to be on there. Medical history and records, not going to be in your credit report. However, if you do have any medical bills that go into collections, those will be on your credit report. Your buying habits aren't on your credit report. Your income is not on your credit report. So when you're doing the loan application, the reason that income is asked for is because that's not something that is going to be given to the lender through your credit report. And then technically, when you access your credit report as a consumer, your credit scores are not going to be on that report, which is an interesting thing a lot of people aren't aware of. Now let's talk about the different levels, right? So where am I at? How do different lenders evaluate my score? So now these are the levels at our credit union. Each lender is a little bit different, but generally these are going to be, pretty similar to what other financial institutions use. So for us at Canopy, an excellent credit score is something that is between 740 to 850, 850 being the highest score. Now keep in mind, once you get above 740 and 750, you're going to get the best rates possible. So it's not as if having a 775 is going to be better than like a 755. Usually you're going to get the same interest rates. Good would be between 680 and 739. Fair, 640 to 679. Poor, 600 to 639, and then needs improvement, 550 and below. Now, when I say needs improvement, that just means that we want to begin to improve that credit score so we can get more affordable interest rates when we need to borrow. Now, our mission at our credit union is to help people who have some of those lower credit scores. So if you're thinking, hey, there isn't an option for me to get financing somewhere, we may have an option for you because it's our specific mission to work with you, not only to offer you the financing you need, but also to help improve your credit score. So 5 factors that go into your credit score. These are really, really important. And we're going to jump into each of these in full detail. So don't feel like you got to write these down right now. I'm going to get into them in just a couple of minutes. But the first factor is, have you paid your bills on time? And this is 35% of your total score. So the percentages you see, they add up to 100. So it shows you the weight of the different factors. How much of your revolving limits are you using? And we'll talk about what those are. That is 30% of your score. How long is your credit history, the average age of your credit history? And that's 15% of your score. Next one, how many accounts and what type of accounts do you have? Now, this is specifically borrowing accounts, so we'll jump into some detail on that. That's 10% of your score. And then finally, how often have you applied for new credit? This would be hard credit inquiry, so that's 10% of your score. So let's jump into these factors and talk a little bit about what each one means and how we can focus on them to improve our credit. So the first, have you paid your bills on time? This is by far the most important credit score factor. And really what this is looking at is, for all the credit accounts that you have had, whether opened or closed, have you made on-time payments for those? And it's a reflection of how you've handled credit in the past. So for instance, a missed payment, a payment that's actually reported late, can drop your score by as many as 60 to 100 points. And when it comes to your credit score, there's an interesting phenomenon that the better your score is, the more you will be punished for a negative item. So for instance, someone who has like a 780 credit score, if they have a 30-day late payment, it may drop their score by as many as 100 points. Whereas somebody who has a 600 credit score and they have a 30-day late payment, that might only drop them down that 50 to 60 point amount. So it's very interesting how that works. So things like collections, bankruptcies, garnishments, charged off accounts, repossessions, those are on your credit report for a long time. Most of those as many as 7 to 7.5 years. And then bankruptcies are 7 to 10 years, depending upon the type of bankruptcy that is filed. So what I always tell people is, if you have a credit card or you have a loan of some type that you're coming up to the payment date and you're just not sure if you can make that payment, one of the best things that you can do is reach out to that lender. Tell them what's going on with your story. Most lenders, and I speak especially for our credit union, we don't want to penalize you on your credit score. We would much rather hear what's going on. How can we be of help to you? How can we help you get through this? Can we work with you to, set up a different payment plan or something like that, so we don't have to report that late payment and we don't have to do that damage to your credit score. So what a lot of people will do is, unfortunately, when they have a payment coming up, they will not reach out to their lender, not communicate. And so unfortunately, since there isn't that communication going back and forth, late payments end up getting reported. And that really can hurt people. So again, reach out whenever you have a debt and you're having a hard time making a payment on that debt. The lender would really, really want to hear from you. So that's the first one, and that was by far the most important one. So, but the next most important factor is, how much of your revolving balances are you using? So an interesting phenomenon in credit scoring is that you are incentivized as a borrower to have revolving credit, things like particularly credit cards. And so if you do not have a credit card, in an interesting situation, you might be penalized a little bit on your score because of that. So if you do not currently have a credit card, one of the recommendations I will usually make to people is, consider getting one, using it responsibly, paying it off in full every month, and that will help continue to boost your score and continue to build it up to those higher levels. You don't have to have a credit card, but it can be challenging to have an excellent credit score without one. So what does this mean? How much of your revolving balances are you using? Now, what it looks at is all the revolving credit that you have available to you and how much of it are you utilizing. So I've put up this example here. Let's say that you have 3 different credit cards in your pocket, and each of them has a $5,000 available limit. That means you have in total $15,000 of revolving credit available to you. Now, let's say that you had $5,000 in balances between the 3 of them. That means that you are using 33% of what's available to you. And so you see the 5,000 out of 15,000. So when that gets reported, the credit bureaus or whoever's pulling your credit is going to see that, and that will impact your score. So the higher that percentage of utilization that you are using, the lower your credit score will be, sometimes by as much as 1 point per percent. So for instance, let's say you only have one credit card in your pocket. It has a $5,000 available limit, and it's been maxed out for several months. Your utilization is at 100%. Your credit score might be 100 points lower than it could be if you were to pay off that credit card in full. And so again, keep in mind, sometimes if you close or open a new credit card, the amount of available credit for you can change and your utilization can change. Now, in an ideal world, we want to keep that utilization rate at 30% or lower, but having no balance is ideal. And I want to take just a couple minutes to address a myth that is out there in regards to building your credit. Some people will tell you that you need to carry a balance on your credit cards in order to build credit. And I'm here to tell you that is absolutely not true. We do want to use our cards, but it doesn't have to be for a high number of transactions. Me personally, I use my card for most of my purchases, but I pay it off in full every single month. And my credit score gets the full benefit of being at that 0% utilization. So if somebody tells you you have to keep a balance and it should be a 30% or whatever on there from month to month, tell them actually that's not true. Because when you think about it from a lender's perspective, what they would ideally like to see is that you are not utilizing that credit, especially if they're considering giving you additional credit. So again, that's a myth that's out there that I always want to make sure I address with people when we're talking about credit scores. The next factor, how long is your credit history? And this makes up 15% of your score. So what's important to point out is these next factors that we're going to talk about actually contribute to a minority of your score. Again, those first two factors, have you paid your bills on time and that utilization ratio, those are 65% of your score. So it's when you're focusing on building your credit, it's far more important to focus on those two factors. Not that these other ones don't count, but they are less significant than the first two. Now, what this is looking at is the average age of your open and closed accounts. Now, what something people don't realize is that some of your closed accounts can actually contribute to the age of your credit history depending upon the scoring model. So for instance, FICO, when a credit account is closed, it no longer counts towards your age of credit history. But Vantage, which is the model that Credit Karma uses, actually will continue to look at your closed accounts for a period of time. So for instance, when I paid off my student loans, my Credit Karma score didn't go down at all. And we'll talk about Credit Karma, but my FICO score did go down because they're different models. So if you are looking at someone who's pulling your FICO score, you may want to be thinking seriously about whether you're going to close accounts or keep them open based on that, average age of credit history. And something to note for people who do not yet have a credit score, maybe if you're younger or you've just never accessed credit, it takes at least 6 months of reporting history for an active and open credit account, credit card, a student loan, an auto loan, before you have a credit score. And something I should point out is many lenders will look at borrowers who do not have a credit score and grade them as if they have a poor credit score. That's not our practice at Canopy. We will grade you out at a fair to good score. So you're going to get a better interest rate with us than you might get other places. But you want to just ask the lender, hey, if I don't have a credit score yet, how are you going to grade me? What interest rate is going to be available to me? Now, what I tell people is when you're building credit, you want to avoid opening up any new accounts, which decreases the average age of your accounts. So for instance, let's say you're looking at doing a debt consolidation loan to pay off some credit cards. In an ideal world, you'd be able to access those funds, pay off the credit cards, and leave them open because they're contributing to the overall age of your credit history. Now, that isn't always going to be possible depending upon your lender, but if it is, that would be my personal recommendation for you. And then the next factor is how many accounts and what type of accounts do you have? This is 10% of your score. So for instance, there are multiple different types of credit that's out there. We have loans, which would be what's called a closed-end credit account, because again, you're going to pay it off and eventually it's going to close. So you have loans, mortgages, and credit cards are the three different types of credit that the credit scoring models are looking at. So to give maximum benefit to your score, you would want to have one of each of those. It doesn't mean that you can't build your score without them. I built my score exclusively, at least initially, by paying all my student loans every single month and then having a small credit card. So you don't have to have a mortgage in order to build your score, but you will be rewarded for as far as your credit score goes if you have multiple different types of accounts. But what I tell people, even given that, is that your credit score isn't increased or built by opening up a huge number of accounts. And we see that with people, especially when they're looking to build credit. One of the misconceptions is that, okay, I need to get lots of different credit accounts in order to build my credit. And that's not actually entirely true. What we want to do instead is have a few accounts that we keep in good standing, that we're able to stay on top of. Unfortunately, what can happen with people is they open up a lot of different credit accounts and they begin to use them actively, and they end up with balances that are not manageable for them. So again, it's only 10% of your score. So especially young people, if you're listening to this, don't go crazy and open up a bunch of credit cards. And then the last factor, how often have you applied for new credit? Now, this is looking specifically, it's 10% of your score. And this is looking specifically at how many hard credit inquiries are on your credit report. Now, real quick, to differentiate between a hard and a soft inquiry, because there's some confusion about that. A hard credit inquiry is when you have actually initiated an application for credit. So for instance, at our credit union, if you're applying for an auto loan, a credit card, or a mortgage, that's going to initiate a hard inquiry. A soft inquiry would be what's done through, like, Credit Karma does a soft inquiry to get information about your score. Credit Sesame does the same thing. If you ever receive a promotional offer in the mail saying that you've been pre-approved for a credit card or a loan of some type, that's a soft inquiry. So that will not impact your credit score. Some people get nervous about that, like, hey, I shouldn't check on it because I don't want to impact my credit. Soft inquiries are okay. Hard credit inquiries will deduct your score. But really, it's usually only about 3 to 5 points per credit inquiry. And if you see here, those hard pulls stay on your credit report for 2 years, but only ones that were initiated within the past 12 months actually factor into your score. So after 1 year, those credit inquiries are no longer having an impact upon your score. Now, something else that I like to point out for auto loans and mortgages, for most dealerships and mortgage lenders, inquiries that were initiated within the past 14 days count as a single inquiry. So let's say, for instance, you're shopping for a car and you go out to multiple different dealerships and different places to try and rate shop and see what's going to be available to you. If they're all done within that 2-week period, the credit scoring models are going to pick that up and treat it as only one inquiry. So there can be a benefit to shopping around, but you just want to make sure to be aware of that, because rates are very important, especially when you're looking at new debt. So make sure that you rate shop and know that you can do that if you do it within a certain time frame without hurting your credit. So let's talk about how can you personally get access to your credit report and your credit score. So federal law entitles you to a free copy, of your credit report every 12 months. And you can only get that from the website that I've listed here, www.annualcreditreport.com. This is the only place where you can get your full credit report for free. And you can pull each credit report once every 12 months from TransUnion, Experian, and Equifax. So what I'll encourage people to do is, hey, maybe in January of the year, you pull your TransUnion credit report. Maybe in June of this year, you pull your Equifax report. And then towards the end of the year, you pull your Experian report. Because let's say you pull that TransUnion one in January, you're not going to be able to pull it again until January of the next year. So you want to space them out so you can consistently check on that information. When I have actually checked my credit report, I have found errors that I have had to dispute and get corrected. They weren't serious and weren't impacting my score, but there was an issue with an address and an employer. And sometimes you want to check on those things and make sure that they're accurate and up to date. And you should know that when you pull your credit report, you will not actually get your credit score when you do that at annualcreditreport.com. You can pay to get that there, but I found most people are going to be okay getting what's called an educational score from an app like Credit Karma, Credit Sesame, or like Discover for their credit cards will give you your credit score. Mint.com, a budgeting tool, will show your credit score. Now keep in mind with those credit scores, they're not doing a hard credit inquiry, which is good. But what that means is that the score that you see there might not actually be what it is when a lender pulls your credit report. So for instance, I used to be a loan officer at our credit union. Every once in a while, I would have a member come in to do a loan, and their Credit Karma app would tell them that their score was at a certain level. But then when I pulled their credit report, did a hard inquiry, it would sometimes be higher or lower than what Credit Karma was saying. That's because, again, Credit Karma is giving you what's called an educational score. You can kind of think of it as an educated guess on what your score is, but they don't have all the information because they're not doing a hard credit pull. So just keep that in mind. And don't be frustrated with your loan officer if it actually ends up being different than what your Credit Karma app shows you. And speaking of Credit Karma, let's talk a little bit about that. It is a free resource, and it's one of my favorite tools in this whole credit realm to help people understand what's going on with their score and with their reports. So what you can see in front of you, this is actually my Credit Karma app. I just went ahead and took a screenshot of it to show you what it looks like if you're not familiar with it or if you haven't used it. So you can see it's got my credit score up there. Again, keep in mind that it's an educational score, and what you'll see there, you can't see it because it's very small, but it says calculated using Vantage Score 3.0. So now that is the Vantage score model, which is different than the FICO model. So again, when we talked a little bit earlier about the differences between the different credit scoring models, remember Credit Karma is using Vantage score, which is most commonly only used by auto dealerships for their lending. It's not usually used by a lot of financial institutions. But what I love about Credit Karma is you can see below where the score is the different credit factors. And we just went through these. The payment history, credit card use, the derogatory marks, which again is really a synonym for payment history, the credit age, the total number of accounts, and the hard increase. Those are the factors that go into your score. And you can see, we can see based on my factors why my credit score is where it's at. I've got a good payment history. My credit card usage is at 0%. Something on that credit card use to keep in mind is 1 month you may be reported as having a balance, and then if you pay it off the next month, it won't be reported as having a balance. So that part of your score can fluctuate quite a bit based on when things are reported. So don't freak out if you see a small dip in your score because of credit card usage. It could just be due to, what balance did you have when that was reported. But you'll see here that the age of my credit history is not very long, 3 years, 4 months, but it's only a medium impact factor. And then my total accounts, again, this is the Vantage model, so it is using some of my closed accounts as well. And then I have a low number of inquiries. So this, again, it's a great tool. If you haven't signed up for it, I would personally recommend it. It's going to really help educate you about how your credit score works and where it's at any given moment in time. So let's talk about how to improve your score quickly. Let's say you're looking to work towards a home purchase, or you want to make a major purchase that you're going to do financing, and you need to build your score. These are the things that you want to do. The first is pay all of your bills on time. Stay current on all of your bills. Now, this includes both credit bills, but also non-credit bills. So for instance, you want to stay on top of your utility payments, because if you get late on those and they're reported to a collection agency, when they get reported to a collection agency, then they show up on your credit report and they can have a negative impact on your score. This can include things like parking tickets, your taxes. You want to pay all those things because we don't want any collections or any negative items to hit our credit report. Medical bills as well. Next thing, if you have credit cards, keep those revolving balances below 30% of your credit limit. Ideally, we want that to be at zero, but I know that can't always be a possibility, so we want to keep those as low as you can. Apply for new accounts only as needed, and I would recommend don't close any unused credit cards, especially if they are older, because the older the account, the more positive it's going to impact the average age of your credit history. So when we're looking to build credit, we don't want to make a whole lot of moves in the credit realm. And then review your credit report for errors. For instance, some people I work with in my individual financial coaching practice, they found out that there is a collection account on their credit report for a debt that wasn't actually theirs. So we want to make sure that you review your credit report, make sure that everything is up to date, because even one late payment or one inaccurately reported item can have an impact upon your score. But a lot of people just don't know what's on there because they don't check their credit report. And then I tell people, have patience. Negative items do drop off eventually. Time is one of the best things that can help your credit score and your credit report. Just doing the consistently positive and good behaviors over time is really going to have a positive impact on your score. Other things, dispute those genuine errors on your credit report, and you need to dispute the errors for each reporting agency. Now, Credit Karma will allow you to dispute things on your credit report right through the app, and that could be a great tool to start with, but I also recommend that you dispute with each of the bureaus. And I've put up the websites where you can do that. You can also just Google TransUnion credit dispute. Now, you want to do it with each one of the reporting agencies so that you cover it on all your credit reports. So again, and it's okay to dispute things online, but make sure that you get any correspondence in writing, whether you're communicating with TransUnion or maybe you're communicating with a collection agency. You want to make sure you get everything in writing so you have a paper trail that you can show later on in the process if you need to. And there are some alternative credit building options that are out there that you don't maybe have to access debt. So for instance, Rental Karma, and there are other services coming into this space. Depending upon your landlord, they will report rent payments as a positive credit item. So there are becoming options where paying your rent on time is going to help boost your credit score. And then Experian Boost is a new service that they've offered. What it will do is you grant them access to look at your transaction history in your primary bank accounts or your credit union accounts to see if you've been paying like your utility bills, your cell phone bill. And sometimes that can lead to a quick boost in your score. It's not usually going to be that much, might be only like 5 to 10 points. But when you're looking to build your score, every point matters, so it's worth looking into. And it's a totally legit service. Now, transitioning kind of to our closing, here are some ways that our credit union can be of help to you. And I would say whether or not you're a member of our credit union, one of the services that we offer, and this is one of the things that I do, is called financial coaching. So we offer individual credit counseling to help you improve your credit score, clean up those credit reports, reach out to collection agencies, get that resolved. And if you'd like to schedule a financial coaching session, you can reach out to me directly. My email address is up there, johnm@canopycu.com, and I've also put up my office phone number. Feel free to reach out to me. Sometimes you may need to access new credit in order to improve your score. So for instance, maybe you need to access a new credit card to improve your utilization ratio. That's one of the things that we can certainly help with. We have great rates and very affordable products. And like I stated earlier, our mission is to help people with challenges in their credit area, in that part of their world, whether they need access to new credit or whether they need help cleaning up their credit score and their credit report. Or if you just need some advice as you consider making a credit-related move, if you want a second set of eyes, you want someone to look at, okay, I'm considering getting this new credit card. What are the things that I should be thinking about as I do this? I get phone calls and emails every week from people just asking for some advice, just looking for, hey, is this the right thing to do? So I'm happy to be that resource for you. And again, if you have any questions or need anything, please feel free to reach out to me directly. And just remember that you're not alone in this area trying to work on improving your credit score and your credit report. So I want to thank you for joining us if you made it to the end of this video. And again, if you have any questions about anything, please feel free to reach out to me.